Good morning and welcome to a new week at Morning Markets. We'll begin today with covering China. Now, we've seen very strong equity performance from Chinese markets overnight, up over 2%, and this is in reaction to the central bank there, the People's Bank of China, holding interest rates at current levels. That was largely expected, but it goes to show, and it's a strong signal to the Chinese markets, that the central bank there is determined to keep credit conditions very easy to try and rebuoy the economy as it recovers and reopens from the COVID headwinds of 2022. Now, this is going to feed into emerging market equity performance today, we expect, and that should largely reverse the negative prints for emerging markets that you can see on your screen right now. So it's a good start to the week, and it's a strong indicator from Chinese officials that they really do intend to keep monetary policy and fiscal policy very easy to try and boost the economy. And this coincides with comments from President Xi last week about trying to maximise demand from the Chinese consumer to help boost the recovery there. So that's very strong. Now, through the week ahead, we start to have leading indicators for economic activity across Europe. Now, this will take us into UK data on Wednesday, and this will give us an indication of just what sort of pace the UK economy has got off to at the start of the year, where some of the indicators were indicating that we might struggle to have any growth this quarter. It will be interesting to see, particularly in the services and construction sectors, whether those indicators will show that growth is actually coming back, and see if there are any pressures on the consumer. And this should indicate whether the UK consumer can then get a further boost from falling inflation through the spring, when gas prices and oil prices, base effects, start to lower inflation materially into the spring. And then that word inflation comes out with regards to the US. At the end of the week, we get the formal print of the Fed's preferred measure of inflation for the month of February, the personal consumption expenditure indicator. Now, this is expected to actually print somewhat higher than market consensus is currently, at around about 0.5 percentage points. This will be a challenge for the Fed because it's much stronger than prints of the last few months, and it's stronger than the Fed perhaps would like, given they've recently slowed the pace of hikes from 75 basis points at the end of last year to 25 basis points in their last meeting. And in fact, two members of the central bank committee there have already come out towards the end of last week and indicated that had they had their wish, the bank would not, the Federal Reserve would not have slowed the pace down to 25 basis points at the last meeting. They would have hiked by 50 basis points. So this, I think, indicates that there is still some surprise amongst US officials at how strong the US economy is operating, despite interest rates being increased to near 5% over the last year. And this is the struggle that these policymakers will face perhaps over most of this year, given the strength of the US economy and the levels of unemployment we're seeing, as well as the demand for workers. So we'll get some updates from central bankers probably next week after this February vintage of data has been absorbed, and as officials look to condition public messaging as we go into the mid-March cycle of meetings, beginning with the Fed. So please join us later in the week as colleagues will update you on the economic activity data for Europe and the UK. Thank you very much.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.